What's going on, guys? It's the Bulls and the Bears here with a weekly recap video with the wheel strategy, and boy, do we have a lot to unpack here in this video. A ton happened this week. There was a lot of great news, and then there was some really bad news, and there was just a ton of trades. I mean, there were cash secured puts that expired worthless. I profited on those. There were covered calls that went through the mix that I profited on those. Bank of America rallied like crazy, and I was able to get out of that position for a good profit. CVS rallied as well very nicely, along with the rest of healthcare, and I got assigned early. I sold calls on CVS. I mentioned this in my midweek update video, and if CVS continued to rally this week, I was just going to roll it, and I'd be fine. I couldn't because I got assigned early, and the shares are gone. All gone. And I had to realize a pretty big loss on that position. So we're going to get into all that. Like I said, we have to unpack a lot of good stuff and then some bad stuff. And I'll explain everything about the CVS debacle. But first, as always, I got to talk about the market and what happened this week. As we have the S&P 500 chart on the screen right here, the daily chart. We had obviously this massive rally going into the week that just kept going. As soon as I thought we were about to stall out right here, we just kept going. We just kept going even higher to the next level of resistance, which was just about 4,600. We didn't quite get there, and then these last 2 days we pulled back. So okay, a little bit of a breath taken by SPY. And then yesterday on Friday, an inside day. I mean, we gapped up on Friday right here, but ultimately sold off a little bit. But we were all within the range of Thursday. This is the high of Thursday. This is the low of Thursday. And Friday was in the middle of all of it. So Friday's day, not really significant. But the fact of the matter is we did pull back a little bit from the highs, and we're no longer at year-to-date highs. Looking at the weekly candle, though, it was a green week. Topping tail, though. Obviously, there was a bit of weakness at the end, but we still finished about 0.69% higher than the previous week. We'll see. I mean, we're just about oversold on the weekly chart. This run-up has been insane, and for a long time, too, just straight up for a while. I wouldn't be surprised to see a pullback. I mean, it would be healthy to see it. So, could this be the start of it? It could be, but I've seen this before, and we just make new highs anyway. So I don't know. We'll see what happens, but overall, not really a crazy week. There were some earnings. There were some healthcare earnings, and healthcare as a whole just had a really great week. Bank earnings were really good. Banks as a whole had a really great week. But the big names like Tesla, Netflix, those were kind of hurt. If we go to Tesla quick, you can see, bang, Tesla had some earnings that investors didn't like, and I think they had a bit of margin compression, that their margins were lower this time around, probably because they had to keep slashing prices on their cars. And Tesla had a really rough couple of days, dropped almost 10% on Thursday and then another 1% on Friday. Netflix also looking bad. I didn't really get to read this report, but dropped 8.5% on Thursday after earnings, and then another 2% the following day on Friday. So some of the big names, the Magnificent Seven, if you will, they had a little bit of a rough time. But the other stuff, the beaten up stuff, the banks, the healthcare sector, the stuff that I've been owning, finally had some momentum. Finally. So we're going to get into it, and we're going to start with Bank of America. Don't worry, we're going to get to CVS soon, but we'll start with the good news first. Bank of America. First, I got to get the wheel graphic up. Oh my God, you're going to love this. Bang. So down below, there's only two positions, my Virgin Galactic shares and then a cash secured put sold on CVS. We're going to talk about that, don't worry. But the stock profits have been greatly reduced to a big negative number of $3,400. My July profits are down $822 because of the CVS loss I had to realize. So big hit to the account there. Well, to the numbers. I mean, the account was always, the loss on the shares were always factored into the account, so nothing really changed there. But in terms of like the year-to-date numbers and the realized profits on the year, that took a big hit. So I'll leave this up on the screen, and we'll talk about Bank of America. So this one, I talked about in my midweek update video because I had already sold it by then. But holy crap, this thing rallied like nuts. Go to the weekly chart. This thing rallied almost 10% this week. 10% in a week. It had earnings, as did other banks, and they were just a lot of money probably just poured into the banking sector because of how beaten up it's been. I mean, look at Bank of America. Since March, I mean, it was up here nicely in the mid-30s. March happened with the banking crisis. It dropped, and it never recovered. It just went sideways. Finally, after 2 earnings reports, one here and one here, along the way, after being depressed for so long, investors are finally like, oh yeah, Bank of America's fine. Let's get some money in this thing. Let's start buying it. So it started to recover back to this area, which I thought this whole time that it could, that it was always very logical, very probable that Bank of America would recover back into this range because there's nothing wrong with it. Didn't really need to sell off like this back in March. So finally it happened. It took a long time. It took like 4 months of pain and suffering, but it finally happened. Up to just about $32 per share after opening around 29 to start the week. So very nice there. I had sold a call at $31, but I was just too worried after, being in a crappy situation for 4 months, a third of the year. I was skeptical that this pop would fade. Last time it got up to this area over here, it faded and sold off a lot. And then I was stuck for a long time after that. So when I got back up there after a really strong day, that really extended day on after earnings up over 4%, I thought it could possibly sell off. And I didn't want to miss my chance to capitalize on a share price of almost $31 on Bank of America. So I closed the whole position. And obviously that was the wrong decision because it rallied further than that. My call that was sold at 31 would have been assigned, and I would have sold my shares at $31, which was the highest price I could have sold it at because of the call. I would have kept all the call premium too because I wouldn't have closed it early, and I would have made an extra $82 on the trade. So I missed out on $82 by not letting the call be assigned. And as a result, I ended up closing the call early. So I bought it back and paid some money to buy that back early. I made a profit on it, but I still paid money to buy it back. And then I sold the shares short of $31. I sold them at $30.78, so I missed out on some share appreciation there as well. But overall, Bank of America, I had 200 shares at $30 per share. I sold them at $30.78. I made $156 profit on the shares. The covered call that I sold them for 30 cents. I bought them back for 19 cents. There was 2 of them. So I made $11 profit on 2 calls, or a total of $22 profit on the calls, for a net profit on the position for this week of $178. So bang, a nice realized gain there. I ended up making a 9% return on that, on the investment of $6,000. So 200 shares at $30 per share is $6,000 investment. I made a total, after all the puts and calls sold and dividends too collected on it, I brought in over $546 on my $6,000 investment. That was a little bit over 9%, and that was over 4 months. So if you extrapolate that to a 12-month annualized basis, it ends up being an annualized return of 27%, and that's great. It didn't really feel like I was doing much with this position. It was stuck for a while, but the calls and puts and dividends, they add up. And then I got some share appreciation at the end too, which was great. And it ended up being a 27% annualized return on that trade. And that's phenomenal because investors, when they're just invested in the market, they're happy with your typical 7 to 10% return every year. And this was a 27% gain. So that's phenomenal. Great play there. Took a while, but the patience paid off. And I'm happy. See ya, Bank of America. It's been a nice ride, but we are moving on. Let's talk about some cash secured puts here. Occidental Petroleum. I sold this one at the end of last week at the 57.50 strike. I collected 20 cents for it, just one put, and look at where it finished, way up here at $60. Didn't even threaten my cash secured put level. I had a closing order out there for 90% profit, so I bought it back. I ended up buying it back for 2 cents and realized 90% of the full premium, and ended up being a $18 profit on that trade. So I will get rid of this line And I will keep this on watch for a future play when it gets back down in near the 58, 57 region, if it does. I love playing this name. I think it's a great stock, great company, and great levels to play. It just keeps bouncing in this area of support, so I'm all for playing puts around here. So we'll keep watching this one for the future. Disney. Another one where I love to play this thing around the mid 80s or just under 90, high 80s, mid 80s, because it has had some very strong historical support around this level. And it got down there this week, and I took advantage by selling puts. On Monday, it dropped over 3% down to just about 85 bucks, 85.50. So I sold the 85 strike for 70 cents, a nice good chunk of premium there. It kind of rallied, had a little weakness. There was a lot of topping tail candles here on the daily chart, but ultimately closed above the cash secured put level. Again, I had a closing order out there for 90% of the total premium, which meant I tried to buy it back for 7 cents, and I did buy it back for 7 cents, which means I profited a total of $63 on this cash secured put. And as you can see, Disney is still pretty much near this bottom area of support. So after this put was closed, I ended up opening another put on Disney. I didn't get the 85 strike because I wasn't paying as much as I wanted to, but I did sell the 86 strike going into next week. So let me adjust this line right here because we are still in Disney, folks. I need to actually add that to the graphic down below. I forgot to do that. But I sold one put for 66 cents, and it expires 7/28, but I sold it at the 86 strike, so now the level is up here. But I mean, 85, 86, that's still a great spot. I'm happy with both prices. The 85 was more advantageous at the time, but now the 86 is the one that's there, that's available, and that's a fine strike too. I mean, that is essentially the bottom of this range. So I'm all for buying Disney around here. So I sold another put, got some good premium, and we are in this trade for next week. Let me update that graphic down below. There we go. Disney cash secured put at 86 on the screen. So we're watching that for next week, and that's good to go. Then we had Virgin Galactic. Talk about that one. This one, again, I still have 200 shares of it at $4 per share. It's been sideways ever since I got assigned. It's been in like a 30-cent range for 3 weeks now, which is great for like wheel strategy. I mean, I'm not really far underwater to where I can't sell calls. You know, I'm pretty close to my average cost, so there's nothing really to be afraid of. And I'm able to sell calls at or above my strike, my cost basis. So I've been selling it at my cost basis of $4. Go down to the hourly chart, zoom out a little bit. You can see the range it's been in. It's been over $4 a few times, but it's always sold off by the time the week ends. Because it got above 4 on Wednesday, right up here. Got up to $4.05, but then sold off. So I have 200 shares at $4. I sold 2 calls this week at the $4 strike. Got 11 cents per contract. Those expired worthless. So I kept all the premium and profited $22 for the week there in income. So that's great. So get rid of that covered call line. Now we just have the 200 shares at $4, but we can lower our break even here by the full 11 cents that I got per contract. So now my break even is going to go from $3.73 down to $3.62. Bam, way down there. So that's a pretty big move in the line. It doesn't sound like a lot, 11 cents, but when you look at it on the chart, that's a pretty big drop. So I mean, yeah, this has been great. This has been a phenomenal wheel position because it's just been sideways around my cost basis, allowing me to sell comfortable covered calls for great premium, and they keep expiring worthless. So I stay in the trade, and I'm able to continue selling calls, and I'll be looking to do that right away on Monday because the call premium at the $4 strike, which is what I've been playing this whole time, is still pretty good because we're still pretty close to it. We're just been in this nice range. So that's great. This has been a very good wheel trade position right here, and we'll see what happens. I'm sure at some point it'll have a spike and I'll be called away, but you know, based on the call premium I've been getting, this is going to be a really good return on my investment for sure. So I'm loving this one right here. And now the moment we've all been waiting for, CVS. So let's go to CVS and wrap up this video. We have a lot to talk about here. So CVS had a massive week. We'll go to the weekly candle here, weekly chart. I mean, 5%, 5.14% move on the week for CVS. I mean, this thing cleared so much price action this week. It got above all of this price action right here. Even this candle here, and I mean, this weekly candle right here closed below where we closed this week. So really, we haven't seen a week close at or above this price since right here, April 3rd. That's insane. We haven't seen these prices at all since April. So it's been 3 months of CVS being below 75, and finally we are back at that range, at those prices. So that's excellent. So that was amazing to see. I had 200 share position at 79.25, so that we're getting pretty close to that. My break even's even closer than that at 76.69, so we're getting pretty close to this position being, you know, back to somewhat normal, back to somewhat stable. But I sold calls this week at the 73 strike. I've kind of been doing that the last couple weeks, even though I say you probably shouldn't be selling calls under your cost basis. And here's why: because you can get yourself in trouble. Not only did CVS rally above 73 and all of a sudden my calls are in the money, and I don't want to sell my shares down here because it would be at a $6 per share loss. What would I do? What do I do? Well, you're going to have to roll the calls, and now you're stuck in a position where you just have to keep rolling the calls so you don't sell your position, which sucks because CVS is doing great, but you're reeling because you sold calls below your cost basis. So that was a position I was in. In my last video, we were already above my covered call. It was already in the money. So I was talking about this already, how I was looking to roll the calls out a couple weeks. CVS has earnings in 2 weeks. So IV is high for that time period. The premiums are high as a result. So I already had done some analysis and saw that if I just roll it out 2 weeks to its earnings week, I could not only get a net credit of premium, but I can actually roll it up to the $75 strike too. So I can put this call position at 73. I can move this call position to the 75 strike as opposed to 73 and get paid to do it, or at the very least break even. So that was always in my back pocket. I wasn't very worried about this week my calls being in the money, because I knew I could just roll it out just 2 more weeks. It's not a lot of time, and I can greatly improve the strike. So I was fine. I wasn't worried about it. We had a dividend on Thursday. The ex-dividend date was Thursday. It was 60 cents per share. I had 200 shares. I was going to get over $120 in dividend income, so I was thrilled about that as well. So everything was going great. I wasn't worried about this position at all until Thursday came. I looked at my positions list, and CVS was non-existent. It was gone. And I was like, you got to be kidding me. And it finally came back to me. All the videos I've seen over the years of the wheel strategy and just trading in general, it finally came back to me. Oh yeah, when there's a dividend and your calls are in the money, there's a good chance you're going to get assigned early. And that's exactly what happened. So as a result, I was assigned at 73, which meant I sold my shares at 73 after having shares at 79.25. So I took a $6.25 loss per share on my position, which meant I had to realize a loss of $1,250 on CVS. But hey, at least I kept the call premium of $30, right? Yeah, so that sucked. And I made a little bit of a PowerPoint to illustrate what I'm talking about with the early assignment and the dividend and why it all happened. So let's go over the details of the position here, of the covered call. So I sold the call for 15 cents or $15, and that meant someone else bought that contract from me for $15. It was a strike price of 73. And there was an ex-dividend date on Thursday. The ex-dividend date was Thursday. The dividend was 0.605 per share, or $60.50 per 100 shares per contract, pretty much. So those are the details of the trade. Let's look at CVS at the end of day Wednesday, because the dividend date, the ex-dividend date, is what's really important, and that was Thursday. So let's look at how everything looked at the end of Wednesday. So CVS was at $74.38. The call, the $73 call, the one that I sold, the one that someone bought from me, was worth, the last trading price that I saw was $1.37 or 137 bucks. So that was the value of the call at the end of Wednesday, which means the call itself, if you're looking at it from the perspective of someone who bought the call, which is very important, that's how we need to look at this, the perspective of someone who bought the call from me. They bought it for 15 cents. It's worth 137. So they are $122 in the profit on the call that they bought. So now let's look at what happens when the call holder exercises. So we have all the details of the trade. We have what the profit is on the call that they have. So what happens if they exercise it? What's the logistics of it? Why does it make sense for them to do it? So they have to buy shares at 73. If they exercise the call, they're exercising their right to buy 100 shares at the $73 strike. So they buy shares at 73. Now it cost them money to buy that call. It cost them money to get the right to buy the shares at 73. That was the 15 cents originally that they paid for the call. So therefore, their average cost, the whole cost, the net cost on the whole position that they have is really $73.15 because you have to factor in the cost to buy the call. So with a cost of 73 bucks, 73.15, and CVS at 74.38, they are instantly up $1.23 per share or $123 profit. Now look at the two different profits. The call profit was 122 bucks. The share profit is 123 bucks. Now it's pretty much equal. We got it. Let's just pretend that it's equal. There's a little bit of nuance with the bid-ask spread and you know, the call price probably could have been $1.38, which meant the profit is really 123 bucks. So there's a little bit of nuance with the rounding. So let's just call it equal. The profit on the shares is equivalent to the profit on the call. Okay, so they're equal. If you just hold the call, or if you could have sold the call and gotten the same profit as you'd have if you exercise the call. The only difference is the dividend of $60.50. If you exercise the call, you have the same profit as you did if you held the call. But now that you own the shares, you also get $60.50 for the dividend. So therefore, it is in the call holder's best interest to exercise the call because you'll have the same profit and you're getting the dividend. While before, if you only held the call, you would not get the dividend. So that's the logistics behind why the call holder exercised early, because they're in a much better position. Now, if there wasn't a dividend being paid this week, then the logistics that you see here, it wouldn't really hold up. It wouldn't be in their best interest to exercise early, even if CVS was at the same price and the call was in the money by the same amount. It wouldn't be in their best interest because there should be added extrinsic value in the call that would make the profit on the call greater than the profit on the shares. So the profit on the call is 122 bucks. Why is that? That's because the call is worth $137. Now let's think about that for a second. CVS is $1.38 over the strike price of 73. And the call is worth $1.37, but let's just call it the same, $1.38. That means the call premium is entirely intrinsic value. It's entirely intrinsic value. There's not an added penny to the value of the call contract over the amount that the shares are over the strike price. The CVS is trading $1.38 over the strike, and the call is worth $1.38. There's no extrinsic value there. It's all intrinsic. There should be added time value to the premium, because this was the end of day Wednesday. There's still Thursday, there's still Friday. So there's still time on the contract. There should be added time value, which means the premium should be higher than this, which means the profit on the call should be higher than this, which means it would be higher than this over here. So it would be in their best interest to hold the call because the profit on the call would be greater than the profit on the shares. But why isn't there extrinsic value? Why is it stuck with only intrinsic value? That's because CVS isn't a volatile name. And with only 2 days left to expiration on a name that's not volatile, The extrinsic value on a typical week would probably be, let's just say, 15 cents. So 15 cents extrinsic value. So on a normal week, the call would be worth, what's that? $1.52. This would be $1.52, which means you would be up $1.37 instead of $1.22, which means it would be beneficial to just sell the call for a profit and get $137 profit as opposed to $123 profit if you just exercise the shares, the call, and sold the shares. But this extrinsic value of 15 bucks, it's being wiped away by the dividend up here, because naturally when there's a dividend, the stock drops by the dividend amount of 60 cents. So in practice, it doesn't always work out this way, especially if it's a quality company. That gap down is typically erased, within partly in the pre-market, and then intraday, it usually recovers that drop. But in practice, it really does drop by the dividend amount. So because there's a built-in 60-cent drop, the premiums on the contracts reflect that. The put premiums are greater than the call premiums in that case, because the stock is expected to go down, which means premiums on the puts, which benefit from the stock going down, are going to be a little bit higher because it's already built in. It's already understood that the stock's going to drop by the dividend. So the put premiums are higher than they normally are, and the call premiums are lower than they normally are. And the 60-cent drop is greater than the 15-cent extrinsic value that would typically be in the contract. So it pretty much wipes away all the extrinsic value, and you're only left with the intrinsic value of $1.37, $1.38. And that's the true reason why this happened, and I usually will happen. So to sum it up, and you can find, I found this definition with Fidelity too on like a website, Fidelity's website. If the dividend amount is greater than the extrinsic value on the call, then you are at a very high risk of being assigned early. That's the best way to look at it. If the dividend is greater than the extrinsic value on the call, you're probably going to get assigned, because it'll be in their best interest to get that dividend and the share profit as opposed to just selling the call for a profit. So that's what happened. That's what you guys need to be aware of if you're doing this situation. If you're doing the wheel, selling calls with dividends on the way, you got to be weary of that, because this can happen. So CVS is no more, but what did I do about that? It really sucks to realize that much of a loss. That really throws everything off on the whole entire year. Pretty much cut my year-to-date profits in half. So what did I do? I decided to sell puts at 73. That's where I sold it. That's where I sold the shares, I sold the shares at 73. Now I'm selling puts at 73 to get back into the position at the same price that I sold the shares at. That way, if I do get into the same position at 73, it'll be as if I never sold them at all, and I can just kind of forget this even happened. So I sold 2 puts at 73, 2 weeks out for earnings. So I was able to capture that earnings volatility. I ended up selling 2 puts for $1.39 each. So that's pretty good. That means I brought in a total of $278 in premium. So if CVS does not come back down, and it goes up, and earnings hits, and it goes even higher, then my puts will expire worthless. I won't get back into CVS. I'll have to just move on with this loss. But at the very least, I'll still profit $278 on the puts. If CVS does come down, and after earnings it stays down, and the puts get assigned at 73, then I'm right back into CVS. As if I never lost it in the first place, because I'll be buying it back at the same price that I sold it at, and I'm just going to treat it as if nothing happened. I'll keep my cost basis still way up here at $79.25. My break even will be the same, and I'll just move on as if I never sold them in the first place. But I will still keep the premium in either case. So no matter what, I'm going to be getting the $278 in put premium. It's just a matter of, will I be back in CVS, or will it be gone for good? So that's the video, guys. A roller coaster of emotions this week, because we had some great stuff with Bank of America. That was phenomenal. We had some cash secured puts that were successful, and I made some nice money there. But then we had the CVS debacle, which kind of ruined everything. Now, there's still a chance that we can get back into it and say this never happened, but I'm kind of thinking it's not going to happen. I think CVS is going to remain strong over the next couple weeks, and I'm just going to have to live with it. But yeah, a wild week this week with the wheel. And my positions list at the moment is pretty bare. I mean, I'm only holding Virgin Galactic shares, and I have a couple cash secured puts sold, but my only share position is just Virgin Galactic. Bank of America and CVS are technically gone right now. So, wow. After a long time, after months and months and months, both names are gone and over with for now. So, on to something new. We got Disney in the mix, and looking at Occidental Petroleum. JD.com is the one that I'm looking at, but just not at a good price yet. DocuSign I'm looking at. So we'll see what happens. I'll keep you guys posted. If you follow me on Twitter, link in the description, you will get my live tweets of when I get in and out of trades, so you can kind of follow along more closely. Or you could just wait till I upload videos twice a week. That's fine too. So that's it, guys. I hope you enjoyed. Thank you for watching. If you did, click the like button, subscribe for more content, and I'll see you all next time.